Hello and welcome back. One of the questions I was asked this week was, should I buy, finance or should I lease a car? What's the best option? My name is Melanie Davies. I'm a licensed independent financial advisor. You can find more out about me on the Financial Advisors Register linked in the description box below. It's important to know that all of my content is general in nature and is considered general advice only. That means it's not specifically tailored to your personal financial situation. So if there's anything that you want to investigate further, always seek out an opinion from a qualified financial advisor to make sure that it's appropriate for you and for your financial situation. Also, my financial services guide is available to download from the description box below. Well, people who have the funds to do so usually buy outright because you own the car straight away and it usually works out cheaper in the long term. Others opt for financing because it spreads out the cost. And others consider lease deals because they do look attractive as the monthly payments are usually lower, plus you're in a new car. But when you run the numbers here in Australia using current interest rates and car prices on the market right now, you will see that the difference between what a car dealership wants you to sign off on and what is actually the cheapest option, well, there's a pretty big difference. Here's the options. You could buy a car outright. That's the cheapest if you have the cash. You own the car, no monthly repayments, but your money's tied up. Secondly, you could finance the car loan. This one spreads out the cost. So you own the car at the end, but the interest does make it more expensive. Thirdly, you could check out a lease. There's lower monthly repayments with this one, but there can be kilometre limits and conditions as well. Leasing is a bit more like renting the car. Leases often include running costs like fuel, servicing, registration and insurance all in one payment. Not all leases, but check the contract. With this one though, you don't own the car unless you choose to buy it at the end by paying the residual amount. Leases often cost more unless you're getting the tax benefits like through a novated lease. So talk to your employer about this one. And then lastly, there's the GFV balloon deal. GFV stands for Guaranteed Future Value, and it's the minimum future value of your car at the end of the loan term, subject to fair wear and tear conditions and agreed kilometres. This is the one car dealers will push you towards. It usually has lower monthly repayments, but the deal can cost you more overall if you buy at the end. They look cheaper to you up front, so they're easier to sell, and they make the car look more affordable than it really is. This one locks you into the car dealership long term. When the balloon is due, you'll have a few options. Trade in and start again, refinance, pay the balloon or hand back the car. They often bundle add-ons as well, like full dealer servicing, which means the dealer can earn more from servicing, the warranty and the insurance. And sometimes there's insurance partnerships in there as well. Easy way to think about the difference between a lease and a GFV deal is, with a GFV, you do own the car from day one with a large lump sum at the end, and you can refinance that, or you can pay it out with money you already have, or you can return the car back to the dealer. Now with the lease, you're pretty much renting the car with an option to buy at the end or walk away from it. And what's that quick, easy way to work out what's what? Well, if you buy it outright, that's definitely the cheapest overall, but there's an opportunity cost with this one. Taking out a loan, well, you own it, but you do pay interest. The lease, well, that's renting with an optional buyout at the end, and GFV, that's usually with lower repayments and a bigger lump sum at the end. There's no one-size-fits-all answer. Whether you're leasing or a GFV balloon loan looks to be the most expensive depends heavily on your situation, how long you like to keep the car, how much you drive it, and whether you'll actually buy it at the end. So to sum up, if you keep cars long term, consider buying or getting a loan. If you love to have a new car every 2 to 3 years, have a look at leasing or GFV. Make sure you always check the total cost, not just the monthly repayments. Read the contract carefully and always ask for help from an independent professional for a second opinion. So let's use a quick, easy, fictitious example to see how this works. So imagine a client who's decided she doesn't want a new car every 2 to 3 years. So then the choice is really between taking out a loan or paying cash. If she withdraws funds from her portfolio now and pays cash for her car, she avoids the interest costs associated with the loan. She eliminates any risk of underperforming returns. So that's if her investment portfolio underperformed, say, her 6% estimated return. And she retains simplicity, no repayments, no loan paperwork, and no debt stress. So what's the downside of withdrawing though? Well, she's going to lose the future compounding benefit and the 6% return over many years. She reduces the size of her investment base and she loses the flexibility with her investment. So withdrawing may reset the long-term wealth building trajectory that she's on. If she takes out a car loan instead, she keeps her investment working, assume returns hold. And if the loan rate is lower than her expected return, say 6% in this example, in theory, her investment could out-earn the loan cost, which is a carry trade. She can preserve liquidity and keep cash in investments for other opportunities or emergencies. So what's the downside of a loan? If the actual portfolio returns fall below 6% or if markets are volatile, the loan cost may exceed the net benefit. Debt's a liability, there's the pressure of repayments, there's risks of rate rises, of cash flow changes, etc. Also, car values generally reduce over time. Cars depreciate, so it's a depreciating asset while you're holding a liability. But if she's a kind of risk-averse person, she'd probably prefer certainty and she'd most likely withdraw funds from her portfolio, pay cash, and that means that she avoids the loan's interest and risk, especially as the car purchase is a one-off and she doesn't want any financial pressure. It's important to remember that everybody's situation is different. So for some people, paying cash is a no-brainer, but for others, when their investments are earning solid long-term returns, it can make more sense to keep that money working and source a shorter-term, secured, lower-interest loan instead. On the other hand, if you value certainty, no debt, and lower risk, paying cash or using the savings remains the safest path. But low-rate loans are a legitimate middle ground. Always seek a second professional opinion and ask for help. Thanks for watching. I'll see you in the next one.